So we're going to do a video here on the relationship between the ETFs, the commodity price, and the general markets. Gary M's asked this question, just trying to understand price action on ETFs, and I'm curious if you know why something like Gush is down 3% when the market and oil are relatively flat. Any insight is helpful. Thanks. Okay, so that's a good point that he brings up, and we saw that the big discrepancy was with the nugget and the the price of the commodity. First off, let's just talk about the structure of these ETFs. This is a the bull 2 times share leverage, as is the Gush. Most of these are 2 times leverage. UVX is 1.5 times leverage. So what makes up how did they get the leverage? They own stock, sure, but mostly they own call options or futures, depending on the structure. Usually near month, and 80% of the position will be near month, and the other 20% is 1 or 2 months out. So in effect, these are designed to go to zero. If the market stayed flat or downtrended, then these would go to zero. And that's why they keep rolling them back. 1 for 4, 1 for 10. UVXY is the epitome of complete rollback. 1 for 5, 1 for 4. This comes from 5 million post rollback or pre-rollback. 5 million. It's designed to go to zero. So a thing like UVXY is not a longer term. Now, some of these other ETFs that we trade, though, that you can buy them for. Now, SOX is SOXL. It says 3 times. I think they're only 2 times now, and it's in this big rising channel. But so how do they do that? Well, they have a basket of semiconductor stocks that they're following, and then they have the calls options near term or next month, and that gives them the leverage. So if markets trade sideways or down, then these will go to zero because the time value of the ETF gets eaten away. Now on the options, the further out you go the option, obviously the bigger the time value, but the longer the time value lasts. As you get close to the expiration within the last week or so, the time value disappears very, very quickly. And as a matter of fact, you see our option guys trading what they call the lottos. That's where the option expires that day or the next day. So there is no time value. It's all intrinsic. And so therefore will move in tandem with the market, whatever the underlying asset is. So this is interesting. Let's go back to Nugget first. Sometimes you get a big disconnect between the price of the commodity and the price of the underlying stock. In the bear cycle here back in March and April, this went from $140 to $25, let's call it. Yet the price of gold was very strong. It was $1,700. And when we got gold up into here, $1,700, we were trading back at $70. But because the market was selling off so sharply, everything got sold off. Margin calls, fear, panic, everything just blows out. And so as this drops so significantly, or the market drops so significantly, all of the call options that they had become worthless, and the value goes to zero. So then, in actual fact, they'd have to roll this back 1 for 5. So this actually went down to $5 or less. Then they rolled it back 1 for 5, and it's popped back up. Then we got a big discrepancy in the commodity price and the price of the gold. Here we got gold to 1700, 1800. No, it was 1700, 1650. It was trading between 1650 and 1750. And the commodity, so we get this big rebound. We get the stocks running. Commodity goes up. We get the price goes to 85. Then markets soften up a bit. Nothing's changed in the price of gold. As a matter of fact, gold strengthened and the price came off. And then now gold is strengthened and the commodity, or the price of the stock, has caught back up to the price of the commodity. So this is a big disconnect. And this is one of the reasons I'm not trading the gold stocks, because there's a big disconnect between the price, maybe coming back into normality, but there was a big disconnect between the price of gold and the price of the commodity and the price of the underlying stocks. So Gush is the same. Oil trades to 40, Gush trades to 67. Oil backs off a bit, trades back to 40, now Gush is 32. Like, what's different? Well, you have to remember that this is only a function of the underlying stocks. This chart here really exemplifies Gush. I mean, this is exactly what Gush looks like. Oil went to 40, APA went to 18 from 5. Oil stays at 40, now it's back to 13. It's come back down, now it's popping out of this wedge. So the price of the commodity, the price of the stock is influenced by the price of the commodity, but is not necessarily a one-for-one correlation. As markets sold off, everything gets sold off, and the oil stocks came down. Now, do people believe that, and this is what's happening, I mean, the market is consolidating in here. If oil starts to go back up and the market starts to rally, then we'll see APA go. So this trades not only as a function of the underlying commodity price, but it also trades as a function of the overall general market. If markets are coming off, if the SPY is coming off, which it's not, it's in a strong rising trend, but if this is breaking down, that means the economy, because this is just a reflection, forward-looking view of what the economy is and all its components. If this breaks down, then we're expecting the economy to shrink, and this will lead it. And if that's the case, then oil's not going to be in demand, and we'll see the price of oil drop. But the market would be already predicting that. Because don't forget, oil is a commodity, so it doesn't necessarily, now futures look out what they think the market's going to trade in the future, but the day-to-day price of the commodity is a function of supply and demand in the real world. So you may see stocks sell off. In this case, oil stocks, because we're talking about Gush. You may see stocks sell off if the markets are coming off because they believe that the commodity price is going to drop. And the commodity price has not dropped yet because it's not future looking, it's supply and demand. Traders may be thinking that, okay, the economy is going to come off. I don't want to pay as much for my oil. I'm thinking I'm going to pay 35 for oil because the economy is going to slow down. But good luck if the price of the commodity, if you need oil and you need to buy it because you want to fill your refinery, you can't sit around and wait for oil to come back to 35 just because the market is projecting it's going to come lower. You have to go out and buy it in the market. So there's two types of buyers. There's speculative buyers, and there's actual buyers that are buying it or selling it, as the case may be, because they produce it or they need it. So, excuse me. So we get back to Gush here. Excuse me, it's not COVID. We get back to Gush here, and last time oil was 40, this was at 70. Now oil's at 40, it's at 32 and selling and coming back. Why? Well, maybe the markets are thinking that, and don't forget, this is a a big portfolio of all the E&Ps, oil and gas E&Ps. So they would, and some of them are going to go broke, some of them are going to do well. At $40, they start to make money, but a lot of them, have had to shut in wells, so their earnings are going to be down. There's a lot of reasons why, this could be selling off the gush, even though oil remains strong. And it's because now that there's a disconnect between the daily commodity price and where the market thinks this is going.